Before we get started, I want to remind everyone that the information in this presentation is not to be or construed as investment advice. The information presented are subject to change without notice, and while we have made every reasonable effort to ensure that the content is reliable and accurate, we have not independently verified the content and are not responsible for errors therein. Please consult a professional advisor before putting a loonie in any of these financial markets.
Hi everyone, my name is Richard Diaz and welcome back to the IceCap Canadian Market Wrap. In this week's episode, we're going to challenge the view that the Canadian economy was in good shape towards the end of 2024. This comment was made by the Bank of Canada recently and reflects a broader view that I was exposed to over the last couple of weeks, which is to lay Canada's problems at the feet of President Trump and skate over Canada's well-entrenched economic malaise. I get that it's politically expedient to blame Canada's troubles on the ongoing trade war, but the view that Canada is doing just fine or that the last decade was like any other simply does not stand up to basic scrutiny and cannot be supported by the data. If President Trump were to reverse course tomorrow, Canada would still face a plethora of structural problems, and only by acknowledging that reality can we seek to remedy it. First, I want to acknowledge that the shift to protectionist U.S. trade policy and the especially chaotic delivery of that policy have increased uncertainty, roiled financial markets, and hurt Canadian business and consumer sentiment. That much is obvious. If trade policy is highly unpredictable, then businesses can't plan and invest, and this will inevitably weigh on growth. I also want to acknowledge that inflation is back to target. Lower inflation has allowed the BOC to cut rates, and this has helped alleviate some of the pressure households were facing servicing their debt. That relief helped consumption and supported retail sales, which did support growth and helped push up per capita GDP towards the end of 2024. But that is cold comfort. The year-on-year change is still zero, and as I've stated several times over the last few months, it's our view that Canada is in recession. This is reflected in the unemployment rate, which continues to rise. Note that this was happening before the trade war, although clearly that won't help it going forward. Continued pessimism will hurt hiring, and rising unemployment will hurt aggregate consumption. What many of the apologists will cite is that GDP is rising. And of course, that is true, but it misses the trick. Per capita GDP has been flat for nearly a decade. This abysmal performance is especially jarring when you compare it to the 37 other countries that make up the OECD, an organization of rich countries. Even adjusted for purchasing power, Canada is nearly dead last in real GDP per capita growth since 2015. What's important to note here is that it wasn't always like this. In the decade prior, Canada's per capita GDP wasn't stellar, but in the middle of the pack and respectable for a rich country. And from 1995 to 2015, it was almost exactly in line with the United States. So how did headline GDP grow while per capita GDP stayed flat? Canada's top-line economic growth has been a function of mass immigration. And this has been good for companies, of course. More people mean more sales. And it's also been good for various types of asset holders. Scarcely been good for regular people. This influx of people massively outstripped the supply of housing, as you can see on the left, and this directly resulted in the increase in house prices and rental prices. This is especially difficult for the working class and those on low end of socioeconomic ladder, as they are overwhelmingly more likely to be renters. Another way to prove this is to break down total GDP growth into population growth and productivity growth. With Canadian productivity growth negative, which is an emergency, according to the Bank of Canada, you can see that all the growth came from population, or as we know now, immigration. This is a massive indictment on the policies Canadians have been subjected to and spells out why, if immigration numbers do start to fall, Canadian growth will surely decline too. One of the reasons that Canada has such weak productivity growth is the lack of capital investment. In real terms, it's been flat for nearly 10 years, and when compared to population, it's an outright decline. Again, the problem was entrenched before the trade wars. Related to the decline in CapEx is the lack of research and development spending in Canada. And adjusted for inflation, again, it's been flat for almost 20 years now and at a 25-year low relative to GDP. The final indicator for this week is industrial production. And again, it's bad news, although it did improve towards the end of the year. Now, it's important to note that most economic data is cyclical. What goes up often comes down, and the opposite is true. Canada right now is suffering through an incredible amount of structural problems, but we do have the opportunity and the resources to get out of it, and eventually we will. Anyway, that's a wrap on this week's episode. Thanks very much for listening. Please like, subscribe, and follow for more. And as always, we manage money for families all across Canada and the world, so please feel free to get in touch.